I think the way the Fed appropriately asserts its independence is to go where the data takes them. And the data since the last meeting, whether that's the bond market, the commodity market, inflation expectations, 80% of the world central banks, which are cutting cyclical equities, are all telling them you're too tight. You need to cut to re-steepen the curve and extend the cycle. So that's the way I think the Fed asserts its independence, rather than trying to have unelected officials try to override policy from elected policymakers.
Right. And in fairness, it looks like most people in the market think that's the direction they will go. But you have this afternoon a market that is selling off, bond yields that are sliding, Craig, and some people looking at that commentary from Dudley and going, well, wait a minute, should we not be assuming that another rate cut or two are necessarily coming?
Well, I think that would be a tone-deaf move. I mean, obviously, we can debate the efficacy of the tariffs, and that's a different sort of policy question. But I think the bigger issue is the central bank has to go where the data is taking it, and the data is sending it a pretty strong message now, and markets need that curve to re-steepen. That's very important for lending, and that's a critical role the central bank can play here. I think Mr. Dudley's off the mark. While we might all agree that these tariffs are misguided from a public policy perspective, it's just not the role of the Fed.
Fred, well, let me bring you in on that, because we also have heard again from China. I call him sort of the unofficial spokesman, Hu Xijin, who's tweeted in just the past hour or so that the Chinese are stimulating their own economy, that the U.S. is not going to be able to hurt them as much as it thinks. Is that true? And what does it mean for the president's trade war that, Mr. Dudley thinks is doing such harm to the U.S. economy?
Well, Kelly, thanks so much for quoting Hu Xijin. You know I read him very closely because he comes closest to what I can find as a reliable report of government thinking, Chinese government thinking. For example, as President Trump has been saying, there had been phone calls from the Chinese to restart trade talks. He said that hasn't happened at all. I think the Dudley message is an important one because you have to assume that it reflects pretty closely what Jay Powell is thinking. And his three reasons why one should be worried about this is that if you actually called the president out, first of all, you'd regain the independence of the Fed. And right now there's a real political fight between the Fed president and the president of the United States, even if the Fed president doesn't want to say that. Let's face it, the last % cut probably wouldn't have been necessary had it not been for President Trump's trade policies. The second part is you want to de-escalate the trade war, and he feels that another trade cut or a half-point cut would perhaps enable the president to escalate the trade war. And then the third part of this is if we go into a deeper economic slowdown, you need all the interest rate ammunition that you can get. You need to keep your powder dry. And if you look at 2008, 2009, we just had a lot more room on interest rate policy than we have now.
Sure, although, Mariann, that didn't necessarily help us then. And now if you looked at the level of bond yields then, they would have suggested a much healthier U.S. economy for the subsequent decade than we actually saw. So how much stock do you put in the fact that the 10-year is below 1.5% now, given that we were down here in 2016 before almost doubling yields and then falling by half again?
Well, first of all, the 150 just compares so favorably to other 10-year interest rates around the globe.
Right.
And when you consider the fact that you've got 16 trillion in negative interest rates, which means people are going to get a cut in their purchasing power at the end of their investment, this is still the best place to invest. So we're going to continue to get overseas investors coming to the U.S. and trying to drive down the interest rates. But the Fed is data-driven, and when we look at the data, we see that consumer spending, which is such a large part of our economy, was up 4.3% last quarter.
Right.
We see manufacturing, which is only 11% of the economy. Orders are flat, which isn't a bad thing. We're probably on track for about a 2% growth, which is not a recession. It's not 3%, but it's certainly not a recession. And I think it's time for Congress to step in and work with the president and get some fiscal policy done.
Right.
And then the Fed can respond to all of that. But I don't think they have to step in front of what may or may not happen with the tariff trade war, and they just respond. So and right now we have good armor for a good economy for the rest of the year.
No, excellent point. So, Mariann, where very specifically, tactically, where should investors be right now? And then I'll ask Craig before we go.
Well, there's a couple of things, but I think short term is the way to play interest rates at this point in time. Secondarily, gold, silver. Silver is working off the put-call ratios, and it's very favorable for silver right now. And then we've also put our clients into an ETF that is basically a structured note. It's a buffer ETF from Innovators. And we're looking out to next August, so we get a lot of upside potential and downside protection.
Okay.